In this video, I'll be showing you the retirement savings hack that lets you never worry about taxes again, and it has nothing to do with what you invest in. It's about controlling what tax bucket your future income comes from. In over 15 years as an advisor and working with hundreds of real retirement plans, I noticed something consistent. The people who feel calm about taxes and worry less about running out of money in retirement, they're not guessing and they aren't lucky either. They just stopped doing default generic retirement planning and started engineering their income more around how tax brackets actually work. If you're new to the channel, my name's Justin. I own a financial planning firm in Lewisburg, Pennsylvania, where we help retirees all across the country make smarter financial decisions. And that's exactly why I'm making this video today, to show you how to build your retirement across 3 tax buckets so the IRS never controls your retirement and you own it every year instead of just having to react to it. So let's dig right into it. And so the problem here is what the system more or less trains people to do. So most people do exactly what the whole retirement planning system nudged them to do. They sign up for the 401k, they deferred income into that pre-tax bucket. They heard, well, don't pay your tax today, pay it later. At the time, it feels like a win. Your paycheck's bigger, your tax bill is smaller. So HR departments, I think they reinforce this because the concept is simple. It gets people to at least save. Financial content reinforces it for the same reason. It's easy to explain. You have people saving for retirement, and even advisors reinforce it because I say default planning scales well, but there are levels to everything, and there's definitely levels to this. So I'd say if you're making high 6 figures and deferring the max into that pre-tax 401k, saving a few thousand in federal tax in any given year, it feels tangible, it feels smart, feels good even. But here's the subtle issue. Deferral can become automatic, not strategic or intentional. And if you've watched any of my other videos, I'm a big believer in being very intentional in your retirement planning. And while putting everything into pre-tax 401k, was the old default, there's also a new one too, worth flagging on the other side. So people will hear this and they'll swing too far the other way and assume that doing all Roth instead is better. And I'd say not necessarily. It just depends on your tax cost, which I'll get to more in a minute. But I'd say paying 32% more or more in taxes just to get money into Roth without understanding how future brackets will be used can often be just as counterproductive as blindly deferring into pre-tax 401k. And I think what almost nobody asks at this stage is a harder question, which is, what does putting my savings on autopilot quietly force me to do later, and what problems can it cause later? And here's what retirees will discover once income planning becomes real and they have to start figuring out how to make withdrawals. So every dollar coming out of that traditional IRA, pre-tax 401k gets taxed as ordinary income, which of course affects how much of your Social Security is taxable, what deductions you're eligible for, all that good stuff. And of course, starting at age 73, you have required minimum distributions, RMDs. It forces income out, whether you need it or not, which stacks on top of everything else, can end up raising your Medicare premiums and just reducing that flexibility in years when control would matter most. But here's where nuance matters though. This doesn't make pre-tax dollars all bad. In fact, they can often be the most underrated retirement income tool when the brackets are filled intentionally. So the issue isn't just deferral, it's blind deferral without a plan for how your withdrawals are actually used. So then the question is, of course, well then how should you be deferring then? How should you be saving, and how should you be making this more intentional? So let's talk about the 3-bucket strategy and how you should look at this. So the strategy isn't avoiding tax, because you can't avoid it. You're going to pay taxes either now or later. It's deciding where your income comes from each year for maximum efficiency. And I say that's why retirees who plan intentionally, they'll build across the 3 tax buckets. So you have that tax deferred, your traditional IRA, pre-tax 401k that probably everybody's familiar with. You also have non-retirement or taxable brokerage accounts. And then you have tax-free buckets, the Roth accounts and properly used HSAs, which can be very underrated. But each bucket, of course, follows different rules. And when you have access to all 3 of them, then you're no longer boxed into a single outcome. Someone with 500,000 in each bucket, for example, has dramatically more flexibility than somebody who might have 1.5 million sitting entirely in pre-tax 401k, for example, even though the totals are identical. But here's the part that I think most explanations skip. So having 3 buckets doesn't just help on its own magically unless you know how to use and sequence them properly. And if you're watching this and thinking, okay, I get this idea, but I don't think I actually know how to do this the right way. I'm not sure how the buckets fit together, what I should be contributing to. Click the link in the description below the video. It'll take you to a page where I go over my retirement process, and there'll be a link there to book a call with me. If I can help, just let me know. Happy to do it. And now getting back to what building across the 3 buckets actually looks like when done right, of course. So this is where most explanations quietly fall apart. People will hear, well, 3 tax buckets and assume the goal is just balance. So a little traditional, a little Roth, a little taxable, but retirement planning isn't a smoothie, right? You don't just throw in some of each ingredient and hope it works out, taste it, then throw in a little more, right? It doesn't work like that. The real question isn't which buckets exist. It's which bucket each additional dollar belongs in and why. And that decision is driven by the tax brackets. So when you're facing high tax rates, pre-tax dollars are incredibly valuable. You're capturing deductions at the most expensive price points, and then you're preserving the ability to withdraw that money later in lower controlled brackets. I mentioned quite a bit in other videos how most retirees can tend to overestimate their tax bracket in retirement, and they don't realize how low their actual average or effective tax rate will be, because in retirement, you're filling the brackets from the bottom up. So your average tax rate could end up being very, very low. On the flip side, though, the lower your tax bracket is, the sequence can turn around. So at those lower tax brackets, locking in tax-free growth can make more sense if the price is reasonable, though, because remember, even getting money into Roth has a tax cost to it. Remember, you have to first pay taxes on that money before it actually goes into Roth, and that tax cost does matter. So I'd say this is where most generic advice starts to break down. People will learn that or believe that all Roth is good or all traditional is good or bad, but they never learn how to decide what should be going where. So each dollar has to, I'd say, earn the right to go into a bucket, and that's going to be based on both your current and future tax brackets. And this isn't just opinion. Let's take a look at the research, because I love looking at the research on this stuff. An excellent paper that looks specifically at retirees who have money spread across traditional IRAs, Roth accounts, and taxable accounts, and how they should optimally save and withdraw. I thought this research was fantastic. This paper actually won Best Paper in Financial Planning in 2018. And what they found is that outcomes aren't driven by which account is, quote, best, or even by higher returns. They're driven by how income is sequenced across those accounts to manage taxes over time. And then, of course, more importantly, that proper sequencing has a significant effect on portfolio longevity. In other words, having multiple buckets matters, but the order you use them in and how this is tailored to you matters a lot more than following just generic advice. And what's interesting is that they found much of the literature on retiree withdrawals contradicts each other, and even big firms like Fidelity and Vanguard tend to recommend what they call generic naive strategies, which could end up being anywhere from 16 to 26% suboptimal. This is exactly why copying rules of thumb just doesn't cut it or shouldn't cut it for your retirement. So once you see stuff like this, usually something starts to click, that flexibility starts to matter more than just hitting a generic balance number for retirement. And so when all your savings are sitting in one bucket, then control is a lot more limited. Your withdrawals are shaped by tax rules, and those changes and effects ripple through your tax return immediately. So having money spread strategically across the different buckets like we talked about restores a lot of that flexibility. For example, you can use tax-deferred dollars to deliberately fill those lower brackets. You can tap Roth when your income spikes or your rules change. And this is where I recommend using Roth strategically when needed, not just saving it for last and possibly never ever getting to utilize it, which defeats the whole point. And this is part of the point in that research paper I mentioned, that a lot of these generic withdrawal strategies, even recommended by big firms, will lead people to never ever using their Roth, which is, again, just counterproductive. So you want something more tailored than that. And then you also want to be able to access those non-retirement or taxable assets when you want income without inflating your return. And this is why I think non-retirement, or what some call brokerage accounts, can be underrated. So they're very powerful when used deliberately because of the way capital gains tax can be more or less controlled. So I'd say flexibility, unfortunately, doesn't eliminate taxes, but it does let you decide when they show up. And so if this approach works so well, why does it often feel uncomfortable when you're building it or when you're saving or allocating? Well, this may all still feel, quote, wrong while you're saving and allocating, and you might be watching videos just like this one for clarity, because these decisions can always feel unsure. There's always that hint of doubt and I think that this is because it violates some of that generic conditioning. Simple rules are given out a lot because they're easy to template to everybody, easy to follow, but it just often ends up causing a lot of doubt. So for example, paying tax now can feel like failure, or like a loss, or deferring everything into IRA or 401k can feel disciplined. Doing all Roth can feel more or less enlightened, right? But retirement isn't about being right just this year. It's about setting everything up to work well over your lifetime. And that can be the tricky part for many, to see down the road that far and see the impact of today's decisions on the future. So some people retire with large balances, but then feel stuck. I see that all the time. Others retire with similar balances, but have full control and clarity around how to use them. And the difference isn't always just intelligence or effort. It's whether those decisions were made intentionally and tied to a future income plan. And I think that's what strategic personal retirement planning actually looks like. And now, if you're wondering how you should be contributing or which buckets you should be filling up specifically, feel free to click the link in the description below the video. There'll be a link there where you can book a call with me. There'll also be a video there to look at my whole retirement process and what goes into it. If I can help, just let me know. Happy to do it. Thanks again, as always, for watching. I appreciate it, and I will see you in the next one.